Much like a report card reflects a student's academic standing, the balance sheet reveals how the company fared financially over the year. That helps us to gauge the company's overall health. It tells us what the company owns and what it owes to others. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of personal finance. If you are looking for decent profit in these stocks, you need to invest in fundamentally sound businesses. You can check whether a company is financially sound by looking at its financial statements. An annual financial statement gives you a comprehensive report of company's activities during the preceding year. It comprises three important statements: cash flow statement, profit and loss statement, and the balance sheet. In today's video, we'll be decoding a company's balance sheet to you. So if you are a new entrant in the stock market and the annual statements look like jargon to you, don't worry. By the end of this video, a company's balance sheet will start making complete sense to you. Balance sheet is a key financial statement of a company showing its financial health as on a date, like as on March 31, 2024. It is published at the end of a quarter as well as a year. It shows what all the company owns on that particular date, called as assets, and what the company owes to others as on the same date, called as liabilities. On your screen, you can see how the balance sheet of a company looks like. Now look at the assets side first. The asset side of the balance sheet majorly consists of two things: current assets and non-current assets. Current assets are the ones which can be converted into cash within a period of 1 year. It typically consists of cash holdings in bank accounts or deposits, trade receivables, that is the cash the company is likely to receive from debtors within a year, short-term loans by the company, and any short-term investments for less than 1 year. Next on the list are non-current assets. Now these are the assets which cannot be converted into cash within a year. These are long-term assets of the company like land and building, machinery, capital work in progress, goodwill, and any other asset like long-term investments made by the company or any long-term lending. Now goodwill. Goodwill is the value of the company's brand and reputation. It is not a physical asset like plant and machinery. Companies with high goodwill are often more attractive to investors and can command higher prices for their products or services. Both current and non-current assets combined will give total assets of the company. Now let's move on to the liabilities side. The liabilities section shows what the company owes to others, that is, what it needs to pay back. Now there are two types of people who are invested in the company. First, the creditors who have given loans to the company, and second, investors who have bought shares of the company. They both come under the liabilities section. So liabilities section can be broadly divided into three parts: current liabilities, non-current liabilities, and shareholders' equity capital. Now current liabilities are those which need to be paid within 1 year. Non-current liabilities are the debts that need to be paid but after 12 months. Coming to shareholders' equity capital. These are the investors who have bought shares of the company, meaning they have an ownership in the company. Higher the assets, the better it is. So suppose the company has good cash compared to peers. It shows the company can sail through tough times. But if there is too much idle cash, it is also not a good sign. It may signify that the company is not finding enough expansion or investment options. Similarly, if the company has high assets like property, then the company may use them for further expansion plans and not opt for debt. Likewise, if a company has huge debt in its balance sheet, it may show that the company is relying heavily on borrowed funds, which may not be a good sign. But how do you decide how much assets or how much liabilities are okay for a company to have? Well, so when seen in isolation, these numbers may not be as useful. These should be compared with peers. The comparison can be done using various ratios. Now these ratios can be compared with peers or the past history of the company to analyze a company's well-being. Let's look at the most popular ratios to give you an idea on how to use the balance sheet data to draw conclusions. So book value of a company shows what investors will get after paying off all the liabilities of the company. The formula is assets minus liabilities. This is basically equal to the shareholders' equity. Now divide book value with the number of outstanding shares of the company to get book value per share. So higher the book value, better for the equity investors. This means if the company is liquidated today, what will the equity investors get per share of the company? So price to book value ratio is one of the important ratios to understand if the company is underpriced or overpriced. So understand it like this. Suppose due to some temporary problems, the stock of a company is available at say a discount or at a price lower than its worth. It is called as underpriced. And if it is available at a price more than its worth, it is called overpriced. So to calculate PB ratio, divide market capitalization of the company by book value per share. Market capitalization is a measure of the size of the company. It is calculated by multiplying the price of a share with total outstanding shares. Now, price to book value ratio shows if the company is undervalued or overvalued. If the ratio is higher than the peers, that means the company is overvalued, means the current price of the stock is more than what it is worth and vice versa. Now this shows how much debt the company has compared to its assets. It is calculated by dividing the total debt with total equity of the company. High debt to equity ratio means the company may have hard time covering its liabilities. Now look at your screens. Infosys has zero debt, therefore its debt equity ratio is 0. It is calculated by dividing the current assets of the company with the current liabilities of the company. Now, this is used to check a company's ability to pay short-term obligations with the company's current assets. So, a higher current ratio is better. It means that the company will be able to take care of its current liabilities comfortably. Now, there are various other ratios that can be used to analyze the health of the company. We had just discussed the most popular ones to help you read and understand a company's balance sheet also. You need to look at the balance sheet along with other financial statements to understand the dynamics of a company better. We'll be coming up with videos to decode the P&L and cash flow statements soon. So don't forget to subscribe to our channel. Also press the bell icon to never miss any important video from us.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.